Imagine waking up tomorrow morning, checking your phone, and finding your bank balance is zero. Your wallet, completely empty. Absolutely nothing. What happens next? I mean, would all the food in the world just suddenly disappear? No. Would houses vanish into thin air? Of course not. People wouldn't just stop working, right? So if all those real, tangible things are still perfectly intact, what exactly is money? Okay, let's dive into this and unravel what money actually is. Welcome to this explainer on the mechanics of money and true financial freedom. Today, we're going on a seriously fascinating journey to demystify personal finance. We're going to transform how you see money, literally shifting it from this stressful source of anxiety into a logical, practical toolkit that you can use to build the exact life you want. Let's get started. Section 1. The illusion of money. So to really grasp financial freedom, we need to completely redefine how we look at money, because money isn't actually wealth, it isn't food, and it sure isn't happiness. Money is just a tool. It's a universal language for exchanging value between people. Think about it. Thousands of years ago, people traded goods directly. You might be like, hey, I'll give you my wheat for your goat. But what if the goat owner didn't want your wheat? That kind of direct trading was just incredibly difficult and super inefficient. So humans invented something everyone could agree had value. First it was shells, then we moved on to gold and silver, followed by coins in the classical era, and eventually paper money. Today, most of our money doesn't even exist in the physical world. It's literally just digital numbers sitting on servers. But you know what the invisible foundation of this whole system is? Trust. Money works purely because people trust it. When you accept a $20 bill today, you're trusting that someone else down the line is going to accept it from you tomorrow. Without that shared trust, the whole shebang falls apart. Money becomes just useless pieces of paper or meaningless digits on a screen. Moving on to Section 2. Inside the banking machine. So once we earn this money that we all collectively trust, where do we actually put it? Well, most of us use a bank. But here's the thing. Banks don't just take your cash and lock it in some impenetrable vault. Nope. When you deposit money, the bank takes a large chunk of it and lends it straight out to someone else. Maybe someone buying a car or starting a small business. They pay you a tiny amount of interest for keeping your money with them, and then they turn around and charge those borrowers a much higher interest rate. That difference between the two rates, that is exactly how the bank makes its profit. Now, obviously, they have to keep enough cash available for customer withdrawals, which actually goes right back to that crucial concept we just talked about, total confidence and trust in the system. Section 3. Interest, friend or foe? Now, interest is basically the double-edged sword of our financial journey. Simply put, it's just the cost of borrowing money. Let's do a quick thought experiment. Imagine you decide to invest $1,000 right now, and you earn a steady 8% on it every single year. Here's where the math starts heavily working in your favor. In year 1, you make $80 on your original money. Nice. But in year 2, you don't just earn interest on your original $1,000. You earn interest on the principal amount plus the previous interest you've already accumulated. This right here is the magic of compound interest. Time literally turns small investments into massive ones. In fact, Albert Einstein supposedly called compound interest the 8th wonder of the world. And whether he actually said that or not, the underlying concept is just unbelievably powerful for anyone trying to build lasting wealth. But remember that double-edged sword? When you're in debt, compound interest is your absolute worst enemy. It works against you day and night, almost like a wrecking ball, making your debt grow super fast. On the flip side, when you're investing, interest becomes your best friend. It quietly plants seeds and grows your wealth over time, literally while you sleep. All right, Section 4. Navigating economic storms. Of course, it's not always smooth sailing. There are inevitable economic headwinds that you're going to have to navigate to protect the wealth you're building. For example, have you ever noticed how your favorite snacks seem to be getting smaller, but the prices at the grocery store keep getting higher? Yeah, that silent thief is inflation. It basically means the purchasing power of your money decreases over time. So years ago, $5 could buy way more than it can today. Why does this happen? Well, sometimes demand grows faster than supply, producing things gets more expensive, or there's just simply too much money floating around in the economy. Now, a little bit of inflation is totally normal, but high inflation, that hurts everyone. Your savings lose value, prices shoot up, and everyday families end up having to spend way more just to maintain their exact same lifestyle. And we have our second major storm, the recession. This is a period when economies just slow down. Factories produce less, consumers tighten their belts and stop spending, and unfortunately, people lose jobs. Recessions can be triggered by a whole bunch of things: high interest rates, financial crises, wars, natural disasters, or even global pandemics. But I want to remind you of something really important here.
Even though recessions are incredibly painful in the moment, history shows us they almost never last forever. Economies recover, businesses adapt, and totally new opportunities pop up. History consistently shows us that economies rise, they fall, and then, predictably, they rise again.
Which brings us to Section 5, Investing for True Freedom. So, to outpace those economic storms and essentially buy back your freedom, you absolutely have to understand how to navigate credit. Think about it like this. Imagine lending your own hard-earned money to two total strangers. One always pays people back exactly on time, and the other rarely does. Who are you going to trust? Obviously, the first person. Well, that is exactly what a credit score tries to measure, how much strangers, like banks, can trust you to repay borrowed money. You build this trust by doing a few simple things: paying your bills on time, using only a small chunk of your available credit, keeping your accounts open for years, and avoiding applying for too many new loans all at once. If you build a strong credit score with these habits, you're going to qualify for much better, much cheaper loan terms. Now, once you've mastered trust and got your credit score dialed in, we hit a really critical fork in the road. You see, saving merely protects your money from loss. It's a safe harbor, which is great, but it's not going to make you wealthy. Investing, on the other hand, is what actively helps your money grow by buying assets that might increase in value over time. And this brilliantly illustrates the different ways you can do that. When you invest, you could buy stocks, which are actual ownership shares in real companies. You could buy bonds, which are basically steady loans you make to governments or businesses. Or you can invest in physical real estate property. Now listen, every single investment carries some level of risk, and higher potential returns almost always come with higher uncertainty. And that is exactly why you need diversification. Seriously, instead of putting everything you own into one single basket, you spread your money across many different types of assets. It's the smartest way to safely manage that risk. But you know what the most crucial takeaway from all of this is? Patience. Patience is literally one of your most valuable financial skills. Making money work for you isn't magic, and it definitely isn't some get-rich-quick scheme. A steady, long-term investing perspective almost always beats trying to predict chaotic, short-term market movements. The people who truly understand these ideas, they don't just earn money working at a job. They systematically set up their money to work for them. Which brings us to the profound conclusion of our explainer today. I love this powerful quote from our source material. The goal isn't to chase money forever. The goal is to build a life where money gives you more choices, more freedom, and more time. Ultimately, money is just a human-made system built entirely on trust. Banks move it, interest grows it, inflation shrinks its purchasing power, and smart investing builds it into lasting wealth. But the true purpose of all these mechanics isn't just to rack up a high score in your bank account. It's about freedom. So I want to leave you with one final provocative question to chew on. Once you've mastered these tools and your money is finally, truly working for you, what will you do with your ultimate freedom and time?